What is going on, everyone? It was 9 o'clock when I hit go live. I'm not late. I'm saying I'm not late. It is 9:01 right now. How is everybody tonight? Hopefully everybody's doing good. Seeing a lot of regulars here. Dookie Pie was waiting since 3:22. I highly doubt that. Chels, what's going on? GoDaddy, what's going on? PB, Missy Ledger, what is going on? Who else is here? Tommy Dimes. I hope you're doing well in the NCAA tournament, Mr. Tommy. ESPN has me doing all right. I only have one team out right now, so I'm doing all right. Doing all right. My Final Four is intact. I did have St. John's going up against Duke. We're doing all right. We are doing good. Ray, what's going on? Ray, it's unfair. I've been seeing a bunch of Michelle's cakes on Instagram, and it's making me want to go get cake. I got to tell you. I really hope she's able to bring something to CA. June, what's going on? All the regulars. Oh, Michelle is here. Michelle, I got to tell you, there was a cake that you made that was on Instagram the other day. It showed up in my reels. Looked amazing. I mean, everything you make looks good, but this one was just ridiculous. Raven, what's going on? Nice. So you're going to make cakes from when we come to Houston? I love it. I love it. A cow-sized cake that feeds 10,000 people. Oh, my God. PB, thank you. Senor Kris, what's going on?
Nothing, man. Just watching you glaze the follow work.
And we got Hollis here. Looking forward to seeing everybody this week. I can't believe it. We're going to be in California on Thursday, Kris.
I know, man. I know.
It's crazy.
It'll be good. It'll be fun. I just woke up, so just give me a minute.
Yeah, take your time.
Dude, this market, all you can do is sleep through it. That's it. There's like every day it's just a new adventure, you know, and you don't know how everything is going to go. And no matter what thesis you can come up with, you just have to live with it. The only thing I can probably safely say is that disruption fears are everywhere. You know, like AI is supposed to disrupt this industry. AI is going to disrupt that industry. AI is going to do this. And so it almost becomes sort of a running joke now, like about how this new AI feature is going to just one-shot an entire industry. And everyone is moving towards AI, but at the same time, Nvidia stays flat. It's like, you know, so I don't know. We'll see what happens.
This is probably going to be a little bit of a different episode, everybody. So we were planning on talking about how the markets are reacting to the war, what happened today. I have something that I want to ask Kris because I'm getting annoyed at the market dynamics. I was doing the research this morning at 6:15, 6:30, and everything's red. Dow's down a couple hundred points. Next thing I know, everything spikes. I'm like, what the hell just happened? I thought it was a glitch because CNBC wasn't real time, yet Seeking Alpha had the Dow up 1,000. Robinhood had the Dow up 1,000. Couldn't figure out what's going on. So I'm like, all right, let me go on X and see if freaking Trump tweeted something. And of course, Trump put something out this morning. And this market is just dictated by how quickly a post comes out at this point. It's dangerous.
Yeah. Unfortunately, this is where we are in the grand scheme of things. And this is why sometimes people say, like, don't be political, like stop giving political commentary. But I'm like, bro, the market is running on political commentary, you know? So you have to kind of adjust your risk basis accordingly. So there's a certain uncertainty principle that's coming into the market where you don't know what's going to happen tomorrow. So people are just, they may not buy the dip every single time. They may say, you know what, I don't know where this ends, how this ends up getting resolved. I personally am a buyer here, but I'm not like fully going in 100% at the same time. Like I'm taking my sweet time, getting those companies that I know that are, that are just way oversold relative to their future growth prospects, where even if I have to sit on some losses for, I don't know, maybe a year or two, it's not gonna bankrupt me. Like here's an example, like Microsoft. Like Microsoft clearly is not getting disrupted. And right now you're getting to buy Microsoft at a 6-year discount relative to its, future growth. So I think the best thing to do is not go extra crazy and try to like bottom feed on the, 70-80% low companies, even though I'm pretty famous for doing that. And instead just focus on high quality, like high classing the portfolio, because regardless of what happens in Iran and all that stuff, inflation, Microsoft is not going to, be a bad business to invest in, whether that be a year from now, 2 years from now, you'll do fine,
So I tried my very best not to take a political stance. Kris is right, though. Look, we are living in unprecedented times, and unfortunately, business and politics do mix. And you don't have to take a political stance, but you have to understand how politics can impact markets, especially in this environment. And we're in a situation where we saw the news take oil to under 90. Oil finished the day at crude 91.33. It was under 90 at one point today. It got down to 88.50. Brent, I believe, got down to 98. All off of a post. Whether we agree with it, whether it's true or not, it settled the markets. Today was a little bit of a risk on. CME Group didn't flinch. They're still pricing in the potential for rate hike this year. So we are not out of the woods. This can turn on a dime. And look, I agree with Kris. I've been buying Microsoft. I think Microsoft is undervalued if you're a long-term investor. I obviously posted on X, I bought more Nvidia last week. I watched part of the Lex Friedman interview with Jensen today. And I don't even know if I'm bullish enough on Nvidia. And I think that's pretty hard to say. If they really hit AGI, this could be a game changer, and I don't even know how you can handicap this.
Well, here's what I'm thinking with AGI. I don't think that this necessarily like the AGI that everyone thinks, where you're literally talking to the entity from the Matrix, right? I think it's a little bit more. It's a lot probably different than that. I do think at some point Nvidia should break out, but everything that we saw last week, that's what I was trying to say. Like, I think the market is forward looking enough to the point where it's saying that future growth is going to slow down. So I'm not going to give it a crazy multiple, which means that it's likely that we see Nvidia end up somewhere in the middle 200s by the end of this year if everything goes right. And maybe it actually sticks around the $200 mark, the low 200s, only because people are just going to be fearful that Nvidia's, growth rate next year is going to be 40% instead of the 70 that we have this year. So, I think we have to be realistic here. I think people sometimes we look at things too backward in nature and be like, look, it's growing at 70%. I'm like, yeah, but what about the future? And then you also have all the concerns around credit. So as much as all these other companies would like to spend a bunch of money on more Nvidia chips, they're hitting theoretical limits on how much debt they can take on, how much capital they can raise in order to support that growth. And then also from an investor standpoint, they're all getting beat up too. Like Meta's getting beat up, Microsoft's getting beat up, Google's getting beat up. And one of the reasons why is probably because of it's probably because of all the additional capex, which means that I'm sure that the boards at these companies are going to say, hey, listen, maybe we need to kind of curtail some of our capex and see if we can lengthen out the investment cycle a bit so that we're not getting hammered on our crap. I mean, did you see the news about JP Morgan offering credit CDSs on debt for the hyperscalers?
I did.
Credit default swaps? That's crazy. Crazy to see that there's actually default swaps out there on credit for the Mag 7. Like, I don't think I could ever have forecasted that ever happening.
Yeah,
But
they
here we
had
are.
so 3 weeks ago they had them on Oracle.
Yeah.
I just found out about it for the Mag 7 today. So, and look, this is why when I made the bet with Tanner, we have a over under gentleman's bet for dinner next time we see each other in 2027 at 250 for Nvidia. And he thought it was going to be well into the upper 200s, low 300s at the end of the year. And I said to him, look, I'll take an over under and I'll take the under on 250. This was before they reported their Q4 earnings. My thesis around it was, while I own a lot of Nvidia and while I think it is super undervalued, the fact that Nvidia couldn't break out after Q3 earnings with a drop the mic moment, the fact that Palantir couldn't break out, and then you come into Q4 and Nvidia couldn't break out again off of the most insane quarter I've ever seen. Palantir couldn't break out. You had Micron. Micron's down again. It's hovering around 400, and their earnings were insane. So I wouldn't be surprised if Nvidia finishes a year at 215, 220. Now, do I think it deserves that? No, I think it deserves to be higher. But the market is worried about when the music stops on the Capex expansion.
Yeah, or at least a slowdown in capex, right? So it's not necessarily that people are not going to spend money, but they'll spend money. And I do think at some point the capex number is going to go negative when it comes to Nvidia's growth, right? So Nvidia's growth is going to end up going into the negatives. I mean, it's a natural part of the investment cycle. So I guess the question then becomes, will Nvidia end up going into value territory if it's earnings growth, not earnings growth, because earnings, they could always buy back a ton of shares, but will revenue growth go from positive to negative? And I think it's very possible by the end of this decade that we see Nvidia growth go down 20, 30, maybe even 50% from where it is today. Not because Nvidia is a bad company or they have a bad product or they don't have stuff. It's just the business that they are in is a very cyclical business. When there's an investment cycle, people go ape shit and they buy a lot of stuff. And then guess what happens? They overbuild. And when you overbuild, you deal with the consequences of that negative move down. Now, Nvidia, of course, is doing its best to try to get around it by making all of these side bets on all of this other stuff to basically create a situation where they're, becoming a little bit more not as cyclical. They want to become something big. The thing is, if 80-90% of your total sales is coming from the cyclical side of the business, then it's really difficult to try to get around it. So I think Nvidia will get its transition. I think Nvidia, in terms of a stock price, I think we could see a day where Nvidia is trading at a 10 PE. Yeah, I could see it.
Micron trades at under a 10 PE. And look, for those of you that disagree, everybody's entitled to their own opinion. You have to keep in mind, if you've been in the markets for a decade or longer and have been paying attention to the markets, we've seen CPUs have boom bust cycles. We've seen DRAM have boom bust cycles. At some point, you can even argue that GPUs had boom bust cycles after the Bitcoin mining craze fluttered out a little bit. And we went into the pandemic era. And think about it, NVIDIA had negative revenue for year over year at one point, right before ChatGPT. I think it was 21, 22, somewhere around there. I'd have to pull it up, but we could absolutely see a boom bust cycle with GPUs. And Kris and I had this conversation back in 23. I got on board on NVIDIA first. And I said, look, my thesis is Capex is going to expand. I don't know when it's going to stop. I thought it would be 3 years. I have since moved my target of when the Capex build out slows down and stops to 28/29. I may move that target out again. Nvidia is not something that I see myself in for the next 5 to 10 years. Now, I could also change my mind on that. But I agree with a lot of the points that Kris made. Long term, if I'm looking 10 years out, I'm a holder at this point. I'm a holder of Microsoft, Meta, Amazon over Nvidia. But for the short term, I think Nvidia's got the most boom out of it because the earnings are that strong and is that undervalued.
Yeah, take a look at this real quick. So here you can see Nvidia from 2015 to 2017, it was growing 53%, and then started to slow down to 43, picked up a little bit. And then all the way from around here in 2018, all the way to 2019, you can see this drop, and then it actually went negative for a little while. And then the GPU craze happened with Ethereum and Bitcoin mining. It went up all the way to 68% and then started to come down again, and it was negative 12, right? And then, of course, because of AI, it reaccelerated, and now it's at 126%. And you can see that since then, it's kind of been going on this direction back down again. Now, one of the differentiators that we're seeing right now, especially on a 12-month trailing basis, is that it's starting to kind of level off here a little bit, where it's actually going from like 72 to 65. But that's only because I'm doing this as a TTM, like looking at it this way, where you're seeing this flat year-over-year growth. So ideally, Jensen would like to maintain 65% growth year over year, but unfortunately, that's not how compounding works, right? After 3 years of 65% growth, that means that like Nvidia would be eating the economies of 5 different countries. What do you call it? Just to maintain that 65% growth rate. Right now, they're doing 215 billion. So according to the projections that are out there, Nvidia is likely going to do, let's see, up to, and this is what the analysts are saying, up till 2029, their growth is going to be there. So in 2029, they're projecting to do almost $560 billion in revenue. And so their growth rate is going to go down from 71% next year to 30%, right? So actually this year it's going to be 71% into 27, and then 27 to 28 is going to be 30%, and then it's going to go to 17%. So depending on what the earnings looks like according to the basic expectations is you're looking at about $13, right? So for a company growing at 17%, that's typically cyclical, at $13 in earnings, let's say you give it a 15 PE, which is fine. You know, you're literally looking at what, like $200, right? Because that's the thing. This multiple compression is going to be violent. That's just the way things are.
It's really a conundrum because there's such incredible growth on the front end, but the back end starts to look like Walmart and Costco. Maybe even a little less.
Well, the challenge that I have with these assumptions, by the way, is that these are assumptions that are made today based on the occurrences
and
now.
They can change on a dime.
Right. That's the challenge that you run into with a lot of these estimates, is that everyone makes these, guesstimations based on today's data. Let's say we have an issue with the credit markets, right? Like inflation goes up, and now all of a sudden you've got a challenge trying to get debt. And the cost of this stuff is just super expensive. If the world figures out that, hey, wait a second, maybe like AI growth is not as strong, and a lot of these analysts, they have to go back and have to re-rate this thing lower, they would probably, go into negative growth again, estimate negative growth. And then the market would correct on Nvidia. So everyone is looking at this right now and saying, we're still early, which is fine. That's a good argument to make. But the thing is, no one really knows. And there could be other things outside of the we're still early debate that may end up causing the market to, not necessarily live up to these estimates. And I think the analysts right now that are covering the stock, they're analyzing this based on like almost guaranteed future growth. And unfortunately, that I don't necessarily agree with that all the time. I think that there are theoretical limits that Nvidia is going to end up hitting, whether that be because of grid capacity, whether that's going to be credit shortages, and whether that's going to be companies just waiting for ROI to come in before they make additional capex guidance. And then on top of it, we can't forget that the hyperscalers are doing what they can to compete against Nvidia too, because they're not willing to pay this crazy margin that Nvidia wants to charge, right? That's why Amazon's working on Trainium, Google's working on its TPUs, Microsoft's working on its Maya series. Even Meta is working on their own thing, and those are your largest customers. Your largest customers are trying to disrupt you. It's not and then you got AMD on the other side, which is starting to catch up too. So it's like you got competitors on all sides. Now that doesn't mean that Nvidia can't compete effectively and beat them all, because I definitely think with Jensen they probably can. But in terms of risk, I would just say be aware of what you're getting yourself into, and don't think that this is like a sure thing. That because I know a lot of people look at this and be like, oh, it's a 20 PE on a forward basis, that means that it's undervalued. And I'm like, I think it's more fairly valued than you want to believe. you know.
So lots to unpack. I'm in the camp of they are going to clean up on revenue and profitability over the next several years. I have no idea how the competitors with TPUs and other GPUs are going to impact them. They're not really impacting them now. They're still growing at rates that are shocking to me. What it's like in 2029, 2030, I have no clue. So yeah. I'm looking at this as, and I was actually talking to my wife about this. I said, I can see this going to 300 sometime next year. Is it going to be a $10 trillion company? I have no idea. At some point, we're going to get a $10 trillion company. Is it going to be Nvidia? I don't know. But once this starts to get into the 275, 300 range, if it gets there, I'm going to have to really reevaluate my situation on it, because my mindset, I just think there's a lot more runway long-term with Amazon. I still believe that. I could be 100% wrong on that. I am so freaking bullish on Amazon. I'm more worried about Amazon in the short term, but on the long end, I think there is tremendous opportunity because of what they're going to be able to do with robotics and AI.
Yeah. See, the thing with Amazon that I like is that they're like a steady Eddie grower. You know, they're growing at a.
Do me a favor. Pull up their SG&A. It's like $170 billion. And that's part of my thesis. Through robotics and AI, they may be able to cut out 20, 30 billion just in SG&A.
No, their SG&A hasn't been growing that much. Their research and development costs are up, but SG&A is fine. Even their operating costs are leveled off.
But how much is SG&A right now?
58 billion?
No,
it's actually down. Yeah, it's only 58 billion.
Hold on.
Dude, Jassy cuts. Jassy is not the type of guy that's like, yeah, let's keep
167 billion.
For Amazon?
Yeah.
No, it's not.
I'm looking at it right now. 167 billion and R&D is 108.
Are we looking? Show me the data that you have.
See if you're on quarterly.
No, I'm on annual.
SG&A 167, R&D 108.
Why is this number wrong then? Hold on. How's that possible? Look at the revenue, 716 billion. So
yeah, cost of goods 356, SG&A 167, R&D 108. Their operating income is 80 billion.
You know what? Let's take this for a test drive. Let's understand what the hell is going on here, because one of us is very, very wrong.
Well, not one of us, one of the platforms, because these are not our numbers.
Right. So do you want to check? Let's share my screen. Let's actually
Let's
look
just
at
pull up
the.
their press release and find it.
Yeah, that's fine.
I'll share your screen. I'll look for the press release.
Yeah. Let me see. Investor relations. See, this is the problem with getting too used to these platforms. Research. Actually, this is from Morningstar.
So I have the press release. I'm not going to the 10K
Okay.
unless I have to.
No, go to it. I'll just go straight to the filings, whatever. Quarterly 10K right here. $100 billion.
Operating expenses, 166.59.
Right, but 160, that's total operating expenses, right?
Consolidated. Oh, wait, I'm sorry. That's Q4. Total for the year is 636. They don't have it freaking broken out.
They should. Hold on.
They need to go to the actual filing.
Yeah, I'm on it right now. Financial statements, supplementary data. Consolidated. Yes. Okay, here we go. So this is operating income, net product sales. Okay, right here. Sales and marketing.
Can you blow it up a little? All right, I can see it.
Oh, hold on. Fulfillment. See, this is the challenge. Look at this. Sales and marketing. This says 47 billion, and general and administrative is 47. This is incorrect because look at fulfillment. It's 109, right? So the data on
part of SG&A. That's not
right. So fiscal has this wrong, and we just caught it right here. So they got that wrong because operating expenses, total operating expenses are 636.
Could you imagine running a business and your operating expenses are over $600 billion?
Operating profit.
Crazy.
Operating expenses. How does this say the operating expenses are only 100? Is this quarterly? Annual. This is Amazon, right? Okay, Amazon. Yeah.
Amazon.
Okay. Operating margin.
So when I look at a company like Amazon that has 168 billion in SG&A, it makes me think that over the next several years, with the route they're going with AI and robotics, if they can cut 20 or 30 billion out of SG&A from fulfillment salaries to whatever.
So this is where I think these guys may have changed things up. Like one is cost of sales. Where's your cost of sales? Because I think they included cost of sales, which is gross profit is 360. What is the gross profit that you have?
Yeah, gross profit's 360 because cost of revenue or cost of sales, whatever they're labeling it as, should be $356 billion.
Right. So this is where they put the other one. So this is why other fulfillment is an other. So the data that they have is correct, except they just labeled it differently. So what your Seeking Alpha did was they combined SG&A and other expenses together. These guys, they have
they got other. So they got SG&A at 167, R&D at 108, and other operating at 4.6, and then total operating expenses 280.5.
Right. So what do you get? What's your total that you get for operating profit?
Operating
show your Seeking Alpha. Show
79.975.
Okay, so we get the same operating profit. Yeah. It's just
how fiscal is breaking it out.
Right. So
Yeah.
Fiscal breaks it out differently, and Seeking Alpha breaks it out
Yeah.
differently.
But
Okay.
regardless, when you
No,
think about
I was getting a
companies,
little heat. No,
then
no, no. I was getting a little heated, man. I don't like using data platforms that aren't accurate. That's not cool because
well, look, this is
that's
why we look into things the way that we do.
yeah.
You
This
know,
is one of the
so
this is one of the reasons why when you're using like LLMs to try to get price targets and all this other stuff, like some of these other platforms are coming out with, I'm like, you better make sure that the data that you're ingesting is accurate because right now we just
100%.
both looked at two different numbers and it's pretty much the same thing. Like right now, everyone here, you can see the SG&A, they include at 167 and other is at 280. Now, at the end of everything, we got the same operating income, which is good. But if you were basing your investing decisions based on these figures over here, like I think Fiscal did a better job. To be honest with you, I would rather have it broken down than try to combine everything into SG&A. But
Yeah,
so
I mean, I like it with SG&A as a separate line item because it shows me a different picture. And for my thesis, in addition to SG&A, at some point, Amazon's not going to be spending $100 billion in R&D. I mean, they may be able to get total operating expenses down to 2.25. I mean, if they do that, that's $55 billion that goes right to the bottom line without increasing revenue. So you got to think at some point they're going to be one of the largest winners in the AI and robotics space. And that makes it a very bullish investment for me long term. So I love Nvidia, but at some point I would like to rotate the profits out of it into Amazon. I just think there's a much longer run rate for Amazon. But at the same
yeah.
time, Nvidia may become Skynet. So who knows?
I mean, at that point, the world is over, right? So
At that point, the world is over.
I mean, we're all going to be out of jobs. We're all going to be basically, I don't know what we're going to be doing. Farming, maybe farming will make a comeback.
We all
Have to
need to
go back
eat,
onto the
right?
field. That's right. You can't disrupt farming. Well, maybe you can. I've seen some robots working in the
I mean,
fields and stuff
shit.
too.
Have you looked at the recent John Deere equipment?
Yeah. It's
Craziness.
yeah. John Deere is trying to become more of a, and this is like every hardware manufacturer. Everyone is trying to sell you like a subscription based hardware thing because it just looks better on earnings. It gives you a better, what is it called? Like multiple because you're not cyclical. So, whatever. We'll see what happens. Everyone keeps talking about LNG. Guys, just know I'm long VG. I'm long next decade. I love natural gas. I think natural gas is there. Just be careful being in it and being too bullish on it. Natural gas has a very, very, if you want like uncontrolled cyclicality, that's natural gas. Natural gas is known as the widowmaker for a reason. Okay. Like literally people have lost fortunes on natural gas. So just temper your expectations, be a long-term investor, realize what you're buying. Right now, you're starting to see this crazy upward move in natural gas prices. But if this thing with Iran gets resolved and natural gas prices, especially in Europe, starts to come down again, then you got some pain that you're going to have to deal with. So for Venture Global and for next decade and all these other things, I would keep your expectations grounded as to what is possible. This is not a high-flying tech company. These are infrastructure plays. Sometimes people believe that you can just buy the company and it's like a long-term growth compounder. And while Venture Global will eventually get there, just know that if anything happens to the resolution of this situation in Iran, things will come back down and you'll have other opportunities where you can probably buy some too. So just, be careful trying to buy oil and natural gas companies at cyclical tops. And I can't say when the cyclical top is because a lot of energy is controlled by geopolitics. I got burned specifically by oil and natural gas at one point because I didn't respect the cyclicality of it. So just keep that.
I got burned for a different reason, but we have both gotten burned in the sector.
Why?
Didn't I tell you the story? So I
About
put a lot of money in Chesapeake Energy.
oh Jesus.
And
With
if I ever
Aubrey
no, no, this
McClendon.
is post Aubrey.
You went long on it post Aubrey?
Post
Oh
Aubrey.
man.
So
Dude, the amount of debt that they had?
no,
Still
it was the acreage that they had, the debt, it wasn't a problem until the pandemic. And this is the problem. Pandemic happened. They had over 10,000 employees. They had like 10,500 or something like that. They just missed the cutoff for relief. They did not get a bailout from the federal government. What happened with oil? Oil went to zero. They had a $240 million debt payment that they missed. Instead of selling land or doing something, they let the company go into bankruptcy and they canceled all the equity holders out, and then they reincorporated those scumbags. But if you go back and look at the land, they had some of the best freaking land. Oh, anyway, story for another day. Moving on, I want you to pull up a little company some people like to call NKE.
NKE was Nike?
I am not a fan of this company, but I just saw the chart. I got to tell you, I'm going to start looking at it now because I said if it started to get near 50, I'd take a look. Okay. It broke through 60. It is approaching 50. The yield is over 3%. I do not follow this company a lot, but the numbers are starting to look interesting.
Okay. Let's take a look.
Yeah, let's take a look at this. So, I mean,
you want to share my screen?
Yeah.
Okay, so their growth rate has basically topped out. It's actually negative. It was down 10%. It recovered to -5. So it's there. Its earnings have been.
You got to look at it. So the whole premise on this is this fiscal year, which ends in May, is going to be a horrible year. Their EPS growth is -30%. Their revenue is flat. The analyst community is showing that next year's EPS is going to grow by 47.5%. And it goes back to a 23 PE.
Yeah, but look at this EBITDA margin, man. EBITDA margin's also dropped off a lot too. So the operating,
it's not got problems. The company's got problems. There's no question about it. They're doing 4.5 billion in EBITDA. It's down 45% from 2021.
And this thing trades at a very high multiple. I don't know what you're seeing in this, brother.
I'm not saying I'm seeing anything. I'm just saying that at 50, it's going to start looking a little interesting. Look at a 5-year chart.
I don't know, man. These brand things, they're like, it's hard to turn around brands that have basically gone out of favor. It's like I'm not saying Nike is completely out of favor, but Nike is definitely not in vogue anymore. You know, like I see more people.
10-year price chart.
I don't care about the last 10 years. I care, like, dude, that's the problem with brands. Brands, if you're in favor and if you're in vogue, you'll do well. But then the minute that your brand loses that brand equity, that's it. You know, you're going to start, like, they do not make a unique product that you can't get anywhere else. Like, there's plenty of companies that make shoes, plenty of companies that make other athletic gear. There's nothing here that I see other than a brand that, by the way, is not nearly as popular as it was before. And I don't know if they can get out of this death spiral. And their earnings are shot. Like, sorry, Steven, I just don't see it.
So when I'm looking at the 10-year chart, I'm having a hard time that this breaks below 50. I really am. I feel like I may want to go bottom fishing. I don't know.
No, man, this is not one of those that you bottom feed. Like, the growth, unfortunately, unless Nike comes up with some kind of giant branding deal with celebrities and with all this other stuff that gets people enticed. I mean, this could end up being the next Converse. You know what I mean? You remember Converse?
I don't know
At one point,
if we can even consider Nike Converse.
I mean, at one point,
I
Converse was
understand
the
your
biggest
point.
thing ever.
I understand
Yeah.
your point.
Yeah, I mean, this is all branded retail, man. Like, people right now, as far as I can tell, no one's like, oh yeah, let me go get the next Nike Dunks anymore. Everyone's like, yeah, let me go get Allbirds, let me get Hokas, let me get, half a dozen other things. And I see also like this next generation of kids, they're not necessarily tied to this brand anymore. Like, this Nike is not the brand that it was once.
But think about this. What if Nike right now sold off from 60 to 50 because of commodity prices going up? What if they're selling off now because everybody believes the cost of goods is going to be much more expensive this year than originally planned? If this somehow breaks through 50 to the downside, this may look really interesting, especially if the war in Iran ends up being over and oil prices come down.
No, I get it that there's definitely some part of their earnings is coming from the tariffs, right? Majority of their stuff is made in China. Like, there's no getting around that, right? But they were in the penalty box even before this thing with tariffs came along. So I think there's a lot more structural problems to Nike. I wouldn't touch it. Like, I have friends that got burned by Under Armour too, thinking that they found some value company. And Under Armour doesn't exactly prove out to be very healthy either. See?
Nike's down 16% a month. All I'm saying is it's looking interesting. That's all I'm saying.
Yeah, well, I don't know, bro. Yeah, look at this. I remember Under Armour, people thought they were getting great value out of it. Not really. Yeah, I'll stay away from these branded companies where everything relies on like popularity. It's just not worth it. And then let's look at revenues for Under Armour. Yeah, revenues are shrinking here too.
Under Armour's still public?
Yeah.
I didn't even realize that.
It's $5 a share. $4, $6 a share, sorry. I'm staying away from these stupid branding companies, bro. Look at Hermes. The company with the bags?
The Birkins?
Hermes. Yeah.
Hermes?
Birkins. Yeah. Look at the thing here. This is look at this. Since 2025, it went from 290 to this. So it's lost 30% since then.
Yeah, I'm not shocked about that.
Yeah, LVMH. I don't know, man. I'm not into investing in these branding companies. Screw that shit. Where one day you're popular, one day you're not, So, yeah.
You see Verizon hovering around 50?
Yeah, man. It's found a new base. Yeah.
We got a new base.
Now it's chilling.
All the turmoil, Verizon is now over 50.
Well, that's because you can't really AI disrupt Verizon and AT&T and T-Mobile, can you? So and they're getting their debt under control too, which is good.
Everybody needs a cell phone, and I think the Frontier deal is going to be very good for them. I think people are underestimating the actual need for spectrum.
Well, not only that, but their cost synergies too from combining the bundling feature between fiber optic and mobile is probably going to help them grow their postpaid business, which should give you a meaningful re-rating. I mean, this thing right now on a forward basis, on a current basis is 12 PE, which is not bad. It's like fair value. I think when I look at Verizon right now, I see fair value at 50. Could it get to 55 in a couple of years? Maybe, but 50 is fair value, which is why it was worth it to buy it at 39.
Yeah, you're
I'm not sure.
7% yield, undervalued. And if it didn't move, you're still getting paid 7%.
Yep. Yep.
I mean, those are the
So,
deals I love. Undervalued stuff like that pays you huge cash flow.
yep, exactly.
I mean, that was just like
Exactly.
Altria Group. You're getting a 10%. The yield on Altria Group was more than the EPS.
Yeah.
It didn't make sense.
Yeah. Altria Group.
I know people don't like it, and that's fine. The
Yeah, I'm just,
reality is that the profitability is the profitability.
yeah. And you can't disrupt tobacco. What are some of the bitty
Tell you, I bought
things?
some more Starwood the other day. Whenever that
Really?
falls, yeah, look, they put a lot of capital to work last year. I think that this is going to reverse, hopefully, the
Jeez,
Iran
man.
situation. And I
You
think that
really
there's
are.
some
You
things
really
like
are dumpster diving. You really are dumpster diving right
dude,
now, man.
Starwood is yielding 11%, Chris.
Yeah.
They have I'm going to bring this up. This is the thing with Starwood. This is what Starwood does. And what you know what they do best is me not looking at a price and me looking at this instead. 10 years of the same dividend every quarter. What's over the
Yeah.
past 10 years? The oil crisis 18, the trade freaking crisis with China, pandemic, high inflation, rising rate environment, Liberation Day, and now this. The quarterly dividend does not change. We're trading at a multi-year low right now. We're getting 11% on the dividend. Let me lock in that cash flow, yield on cost. I don't think Starwood's going to 23 or 24 anytime soon. Is it going to go to 19 or 20 when this situation disappears and it looks like we're going to get 2 cuts again this year? Probably.
I'd say be careful with this one only because
Starwood's got great assets and the best CEO in the game.
listen, that's the problem that I have with Starwood, okay? The assets are very hard to value. I mean, I get it that you think that they're the best assets, but if the
I said
market
best
doesn't judge
CEO
them,
in the game. I said great assets, best CEO in the game. Barry Sternlich wrote the book.
I know, which is great, but we're in a different time, man. And if real estate, values are harder to value, I'm not sure how you're going to do it. So I don't know. I would say to you, good luck with it. I think it'll do fine if you're looking for, a performer, market perform, but I don't see this
All I
going
want
too
this to
much
do
better.
is trade sideways and pay me. That's
I
it.
mean, how are they covering their dividend? Like, what's their dividend
It's all
coverage ratio?
they were 1 penny over on distributable earnings.
And
It's
their
all
distributor earnings are growing?
It's staying relatively flat.
Yeah. Dookie Pie says, I know you're an RCL. Bro, cruise lines are the bomb.com, man.
Cruise
Cruises are
lines got a
awesome.
little bit of reprieve today.
Yeah, man. They're dealing with all the fluctuations from oil prices. Them and the airlines are dependent. Like, cruise lines are on paper dependent on oil prices, but what people may or may not understand about them is that they all have, and I think we spoke about it last time, they have hedging programs. So the impact on their earnings is not immediate, so they can sort of weather the storm a little bit. The other thing is with cruise lines is that they can add something called fuel surcharges that are ticket pricing. So whenever you have fuel surcharges that get placed under there, it doesn't help your margins, but it doesn't erode them either. So that's one of the things I like about that. And so the number of people going on cruises continues to grow. They're profitable companies. They can buy back shares. They're working there. Each one is a little bit different. RCL especially is doing well because they've got these massive ships that are always packed out. Their margins are very healthy. They're buying back shares, pay a good dividend. So if you get to buy RCL sometimes at a good discount or a good price, it's not a bad idea to buy. Same thing with Carnival and Norwegian. Both of them have their own issues, of course, that they have to work on individually, but There's opportunities there. I think that there's actually better opportunities right now in private credit. I think this private credit distress that's coming out and people are getting nervous about, I think is a little bit overblown. I think this is closer to the regional banking crisis than '08. '08, the problem was credit quality. Right now, I think the credit quality among the private credit guys is fine. Like everyone is paying on time, everyone's paying their bills. There are some outliers here and there that, but that's well within their, tolerances as what they can accept. And the yields on them are very strong. And I think over time, if you pick the right private credit and private equity company, and if they have enough dry powder, they're going to be buying stuff up right now at literally like maybe 50 cents on the dollar, in
Did you
which
see
case
what
you'll get
Goldman
great
did?
returns. Huh?
You see what Goldman did?
No, what?
They're in early talks to raise at least, okay, keywords are at least 10 billion for their private credit fund.
Goldman did that?
Goldman's coming in to sweep shit up.
Fucking Goldman.
Just like what you said, buying stuff at 50 cents on the dollar.
Goldman is greedy as fuck.
Is freaking on the prowl.
What's his name from Saba Capital's been buying a bunch of stuff. They're trying to buy up the BDC from Blue Owl. What's his name? God damn it. He's from Saba Capital. I forgot his name. It's like on the tip of my tongue. But basically, everyone is buying these things up because most of the stuff that's out there that's in some of these credit funds, it's like senior secured debt. Like first lien, senior secured with with positive EBITDA. If you're buying into companies with negative EBITDA, it's one thing, but you're buying into companies with positive EBITDA. So from a credit standpoint, you're going to be fine. Even if, let's say, multiples compress on some software company that you bought 2-3 years ago, what do you care? You're getting your coupons, you're getting paid. Even if there's, let's say, some restructuring or whatever, and you have to sell at 50 cents on the dollar, you're gonna be made whole. You're not. People forget that about a business. When you look at a business and it's 100, like let's say the business is worth $100, usually about 50 to 70% of it is just debt, and then you've got the other 30%, which is equity. And then over time, what happens is that equity starts to grow as you pay off the debt, and eventually you can become debt free. A lot of these companies in the mid cap space that these private guys invest in, they're probably 50 to 60% debt and 50% equity. If the equity gets wiped out, you still got 50% sitting there that makes you whole as a first lien. Like I've seen so many bankruptcy cases. I have yet to see one bankruptcy, where first lien, senior secured, took less than an 80% clawback. I think that's the least I've ever seen. Every single one of them has literally gotten 100%. Every single one I think about, only one got less than that.
I mean, the BDC that Kris was talking about from Blue Owl, they have two BDCs, OBDC and OBDC2. OBDC is the public BDC, which is Business Development Corporation. So I just pulled up the debt structure. They finished Q4 with 73.1% of their assets in first lien debt, 5.2% second lien debt.
Yeah, so 75% of their stuff is pretty good, man, especially covered.
Yeah, and check this out. 96.4% of their debt investments are floating rate, which is freaking great.
Yeah.
Great. I mean, their weighted average total yield on occurring debt, 10%.
See, the problem with the market right now is the market's really going like crazy, and they're not necessarily understanding what they're buying into. Like I've been doing my research and trying to find the best equity.
I mean, Kris, you gotta love that. 79% senior secured.
That's what I'm saying.
I love that. I'm in it.
Yeah, and they've got positive EBITDA, and they've got, look at their net LTV, loan to value ratio, 42%.
Listen, I'm in it.
Most of
13%
them,
yield, Chris.
and most of them have interest coverage twice. So what's the issue here? Will they have
13%
some
yield.
companies? Like I said, I think this is all just a bunch of BS when it comes to softwares getting disrupted, blah, blah, blah. And not to mention, look, Blue Owl probably has a little bit more exposure to software, but there's plenty of other private credit funds that don't have nearly the amount of exposure, and they have enough to cover their, their day-to-day stuff. So whatever, we'll see. Though there is a couple of things that we do have to keep in mind when it comes to software. Other senior secured debt is usually covered by some assets. Software is one of those things that doesn't have a lot of assets. So let's say, you do get disrupted. You could probably lose a good amount of money in that. The thing is, these guys operate in the mid markets where I don't see a lot of software companies that are not like system of record or specialty.
Chris, hold that thought.
Yeah.
OBDC's internet software and services is only 11% of the portfolio. So this whole scare that they're getting caught up in, they have minimal exposure to.
Okay, so let me give you a little bit of just a pause here. You see that healthcare technology thing? You see that?
Healthcare providers and services, or healthcare technology?
Right. So one of the comments that I heard one of the hedge funds make about
that's got to be ERP systems. I'm sorry, EHR systems, right?
You don't know. Likely? We don't know. That's the thing. They're not like, they don't give you a list of everything, so you can't tell. The problem that you have to figure out here, Stephen, is that because there's not as much transparency on what they have under there and what kind of deals that they have. Some of these private credit guys have been saying they let's say it's a software for like a hotel management, right? Like a hotel room management software. They don't classify that as software. They'll classify it as hospitality. You know what I mean? So a lot of the stuff that's there, it's like financial services that's down there. It could be a software company that provides majority of its services for financial services. So they won't list it as a software company. They'll say, oh, it's a financial services, like adjacent company. So it's technically considered something else. So like I said, this is just what I heard. You have to be very, very selective with which horses that you want to bet on. But as far as I can tell, the three that I would not doubt, Apollo is amazing. Like Apollo is not going anywhere.
That's the one I don't own.
Apollo is great. Blackstone, another one, great. The one that there's like a dark horse that not a lot of people talk about, which I think is really good, is TPG. TPG is about $15 billion in market cap, but they manage $300 billion in AUM. And here's the best part. I think about 70 billion is still they still haven't really deployed it yet. So it's not generating any fee revenue yet. So they've got a lot of dry powder. So if they're able to pick up a lot of great stuff on the cheap here, they'll be good. And TPG has been around for a while. Like they're not like some new kid from the block. So yeah,
look, these companies are not for most people. These are very hard to do your due diligence on. The whole problem with these companies, you can't get a lot of insight into their holdings because they're private companies and private debt. It's very hard to do your research. So you're basically betting on the fund managers.
Not only that, but you have to take private and public and combine them together to try to figure out NAVs, right? So here's an example. If you have a public company that's a software company and it's trading at a certain multiple, if you use that same multiple against a private company, and the private company, that's how you get your NAV. So that's how you get your net asset value. If the public company multiple comes down significantly, does that NAV drop for that private company? And the thing is, you don't know how much it'll drop by. That's the challenge that you have
Yeah.
with trying to value these things. Now, here's the thing that you can do. You can try to take the cash flows and weigh it against that. But once again, unless you have like granular details on every single one, you can't tell. So sometimes this is just plain figure out which part of the stack you want to be in. Do you want to be in the credit portion? Do you want to be in the equity portion? And how much of a discount are you willing to pay? Some of these BDCs, they're trading at, I kid you not, 50%.
I was just going to say,
NAV.
I can build it out because OBDC has a book value or NAV, whatever you want to call
20.
it, 1481 for them.
Who was no? Which other ones was I looking at? That was almost like 20. It was trading at like 9.
FSK probably.
FSK, yes,
Yeah.
FSK,
Yeah.
FSK.
People don't like the debt stack. That's why FSK trades at a ridiculous discount to NAV. But if you believe that their fund managers know what they're doing, FSK looks like something that is very interesting. But
Well,
the
FSK,
main three,
FSK also cut their dividend too, so that's why
they did.
That's why their people are freaking out about it.
Okay, so they cut their dividend, but they're still yielding 20%.
25%.
I mean, they're paying. So hold on. Is this including the special dividend though?
So they're putting it back to like 40 cents, I think, per quarter from 70 cents.
Yeah. So let me show this. Is they were paying a special dividend for a long time, which is probably going out the door. And they were getting up to 70 cents. It was 64 plus 6, so they were at 70. Mm-hmm. They just went 45 and 3. They'll probably just go 45, but 45 times 4 is $1.80 on a $10.38 stock. Pretty high freaking yield. You got 19% yield right there.
You're getting paid. You are getting paid a lot.
They paid 19% without a special. And check this out: 1038. We go to the book value, which is NAV. Book value is $20.88. Tangible book value is the same thing. You're buying this at a 50% discount and getting paid 18%.
Let me just say that again. According to them. According to them.
According to them.
According to them. That's the challenge when it comes to investing in all of this private equity and private credit stuff. According to them, they're worth $20.
But you know what happens if in the second half of this year, it looks like we're going to get rate cuts. A lot of these problems that are hitting these companies kind of go away.
100%. 100%.
Like that's the other thing that makes this very interesting. And you're getting paid very handsomely to take that risk.
Also, a lot of the debt that they have could actually become more.
Yeah, keep going because you're right. You're right.
It could become
more valuable,
right? Because
go down because the yield is higher, and you have an inverse relationship with bonds.
Right. That's what happened with the regional banks, right? You had a bunch of them that owned a shit ton of treasuries that were yielding 3% and 4%, which was fine in 2020 when they issued, when they bought them, but then they sat on a whole bunch of AOCI losses. But see, that's the difference between the banks and these guys, where banks are a lot more transparent because of the regulatory framework, so you could value it easier. With private equity, it's not necessarily as transparent, you know, so
it's super difficult. Private equity is super difficult. And look, that's why the names that Kris mentioned, your Blackstones, your TPG, and your Apollos, a lot of people would rather go with them, especially a Blackstone or Apollo. People will even throw in Ares Capital in that. But look, FSK and OBDC, they're not, I would say, in my opinion, they're a B tier compared to an A tier, where the other ones I would say are an A tier, or at least Blackstone, Apollo, and Ares.
Did you ever watch Landman? Like,
dude, it's the best new show on TV.
1 second, John. There was this one scene. I'll just share that one thing. Hold on. Give me 1 second to just pull it up. But
I'm not showing it. I'm not trying to get any strikes, Chris. This is definitely copyright. I can see what you're looking at.
It's just a clip. It's a very small clip.
I can't take the chance. I know exactly what you want to show.
Yeah. But basically, that's how private deals are negotiated, right?
100%.
They're not nearly as transparent. So
I wish Matt would become a land man.
I think Matt's got a better time being a fund manager and a e-thug on
Dude,
Twitter.
he could do both. He could do both. I got faith in him. He could do both.
I mean, he's got the money for it now.
He's got the knowledge for it.
You know, he's good. Matt is good now, so
He's got the knowledge.
where do you guys lock your wives up? In the kitchen. Duh. Where else? Where else?
You're so bad. You're so bad.
Make the kitchen great again. Hilarious. I think we can end it here. We just, you know what, this is starting to become this like Monday night just conversation. It's just like a vent session for me. I have a lot of like thoughts on.
Whoa. Billy Bob isn't actually doing Landman work. Oh, okay. Matt, I thought what you were saying is that he's not going to be in season 3.
Bro, without Billy Bob, there is no Landman.
There is no Landman without Billy Bob.
What am I trying to watch? Fucking Cooper? Cooper who figured out how to fucking drill oil wells in like a week? I'm good. I'm good. I don't need to watch Cooper Norris. Sorry, Cooper. I mean, I'll watch for Ollie Lauder. I used to have a poster of Ollie Lauder when I was in college.
You know what other show on Paramount's really good? Lioness.
I haven't seen it.
I watched it. It was pretty damn good.
Billy Bob just voiced on VG commercial and Steve still refuses to buy. Did he really? No way.
Matt, take that back. I am a fellow VG shareholder, sir. I've been in VG since 675. I just didn't buy enough.
Let's see.
See, look, the chat knows. Linus is amazing from Hollis. Love it.
Matt, send me the commercial. I want to see it. I want to see the commercial, Matt. I saw it on X.
And we got new TV news today. The Dudden Ranch is coming back with Rip and Beth in May. I am so ready.
That'll be good.
I'm so ready for the Yellowstone freaking.
You know, what's his name? Grimes, Luke Grimes. He ended up in one of this, like, he's still in the same universe. He's in a different show now, though. I forgot what that show is called. I haven't seen it yet. Let's see.
Dookie, how many times do I have to show this that I don't use hairspray? Why would I use hairspray at 10 p.m.? This is my natural hair. I mean, there's no hairspray. My natural hair.
Yeah. Whatever. Damn it, I'm having a tough time finding that commercial. I thought it was just right there. Media. Let's see.
All right. You want to call it?
Yeah, I think we can call it. By the way, everyone who is here, me and Matt, because of scheduling conflicts, we are moving Cash Flow Chronicles to Wednesday. So just letting y'all know, it is no longer on Tuesday nights. It's going to be on Wednesday nights. So, yeah. Apollo gives investors only 45% of requested withdrawals from $15 billion fund. Ooh, let's see. Man, these lockups. Let's see.
They get you with those lockups.
Apollo's private credit fund receives, unlike rivals like Blackstone, which recently relaxed redemption, Apollo's holding firm on the 5% cap framing restriction as value protection. Yeah, absolutely. I really don't understand why people think that these things are in the disclosure. Like, Which one is it for Apollo?
Look,
Apollo
if
Asset
you should not, nobody should be putting in money to these private equity funds that have lockups if you actually need it.
It's not public. That's the other thing. It's a private. Yeah, it's private. So
Yeah, I sent.
or if you really want to, you could just hang around and buy public ones, because you could just get out of those if you want. Like right now, if you wanted to buy some of the public BDCs, those you just sell. You don't. There's no lockup period because you can get out of it. These they have provisions in them that restrict the flow. And by the way, there's a big difference between the BDC and the actual corporate
Huge.
stuff. Apollo
Huge difference.
and Apollo Debt Solutions. So Apollo stock is different. So Apollo's at 110 right now, 66 billion. What's their I wonder what their DE is. Distributable cash flow. Let's see.
For those of you that were talking about Ondas, they have entered into a definitive agreement to acquire Worldview Enterprises, which specializes in high altitude balloon intelligence, surveillance, and reconnaissance for I have no idea what the hell they're trying to say here. Something remote sensing.
I'm gonna have to read through all of this stuff. Fixed income. Is this like Athene is one of their hidden jewels, by the way. I don't know if you know what Athene is. It's
I
like
have
their
no idea
insurance.
what it is.
It's permanent capital. Permanent capital through insurance. Man, all of these things have so much fluff in them. Okay, so by 2029, they're looking at adjusted net income about 15 billion. Fee-related earnings is going to be 5 billion. That's a lot of growth. Capital solutions, originations, organic inflows. What's their target? Spread earnings almost 5 billion. After tax, FRE. This is what when you're trying to value a private equity company, this is what you want to look at, FRE. Interesting. Base dividend growth, share repurchases. Yeah, I think I'm going to start building a portfolio specifically just for private equity.
Have you looked at Robinhood's fund?
No, I don't care about Robinhood's fund.
What?
I really don't care about Robinhood's fund. Like I found Robinhood to. You guys are my friends. So I don't want to say anything bad about your friends over at Robinhood, even though.
It's up. RVI is up. I should have bought it when it freaking sold off the day of the freaking IPO.
I find it to be somewhat scammy, dude. I don't like that they do that where they take these late stage venture backed companies and basically try to sell it to retail investors through this fund. But that's just me, you know.
I should have bought it. I mean, that's part of the reason why I own BST, because BlackRock, the Science and Technology Fund, they have both Anthropic and Anduril and Databricks private placements inside of the fund.
Yeah, this is one of those things that I feel like it could end up hurting people. So I'm not a big fan of this Robinhood Ventures fund because, once again, this thing is illiquid. And so you don't know what this thing is going to be worth on the public markets. You're just basically trusting this thing. And so a lot of companies that are listed in there, they're very, very late cycle companies. So,
Well, Chris, if you want to get paid an 8% yield from a closed-end fund that has exposure to not just Nvidia, Broadcom, Microsoft, and Apple, but also Databricks, Anduril, Anthropic private placements.
that's
The
actually not
BlackRock,
bad.
the
That is not
BlackRock
bad.
Science and Technology Trust.
Huh.
I've owned it for years.
Like they own ordinary shares?
They own
And they're trading at a discount? They're trading at a discount right
I
now?
think the discount's 7%. I can go to the website and tell you.
No. I'm saying like, yeah.
Yeah, the
BST.
discount's like 7.5%, I think. Hold on. Yeah, negative 7.57% discount, Chris.
That's not bad. That is not bad, sir.
And you're getting paid 8%.
8% dividend? How do they pay? How do they afford that dividend?
Cover calls, baby.
Ah, it's one of those.
It's BlackRock.
It's one of those, man. I thought this was one of. Okay, now I'm good. I'm good.
What do you mean? Dude. Where do I have to go back to Seeking Alpha for it to show you how much of a dividend history they have? Or I should
Sure,
use
why
the
not?
correct terminology.
So wait. So they do what? Like they do covered calls? That's their thing?
On Nvidia and freaking Microsoft. Yeah.
It's not bad, I guess. I mean, there's a lot of companies that you could do covered calls on. The other ones are just garbage, man. Like, what are they called? Like the TSLY that pay you like.
Yeah, no, that's completely different.
Okay.
So look at this. Their distribution history is freaking great. And I got a nice big special one in December. It's a nice Christmas present from me.
Okay.
But look at that decade-long history of increases.
Yeah.
Just saying, in BlackRock we trust.
I mean, there's a lot of volatility this year. They might actually do really well. They're probably going to make a good amount of money this year because of all the volatility.
All I'm saying is this is a lot of income to be paid out since 2015. And it's
what's BSTZ then?
So, okay. BSTZ is the term trust, where it's not just a trust, it's a term trust. I believe the date is 2031 or 2032. There's a perpetual component of it where you automatically get a redemption at a certain price.
Ah, okay.
So even if it's trading under NAV or under that price, the fund that BlackRock buys everything back at a very specific price. I'm just forgetting what that price is at the moment.
It's trading at a 12% discount right now to NAV.
Yeah, I own that
and
one.
It's got a 9% dividend.
I own it also.
A fund was launched in 2019. When does it?
I'm going to go to the article I wrote about because I know I put it in there. Hold on.
BlackRock, BSTZ, investment objective provide total return income primarily through long-term capital appreciation. Okay, that's good. Under normal market conditions, the trust will invest in at least 80% total assets into equities. Okay. Sustainable growth potential advancement. So where does it say that they do covered calls? 16% of their fund is Databricks, Nvidia. Nah, the other one's probably better. This is like
so the BSTZ launched in 2019 with a 12-year time duration with its initial term, which is set to dissolve on June 26, 2031. And the offer would allow BSTZ to purchase all of its outstanding common shares at NAV per share on the expiration date. So if it's trading at a 12% discount, all the shares get bought back at NAV. So you get the gap closed.
Interesting. And you get a 9% yield right now, and they're able to maintain their yield?
Yes, sir.
I don't know. I'll research it some more, but I'm not a fan. I could do this myself and just buy the Nvidia shares and just sell covered calls myself.
You could, but
Why do I need them to do
you
it?
wouldn't have exposure to Anthropic,
True.
Andril, and Databricks.
True.
That was the whole reason why I thought BST was really interesting, because it allowed me to get indirect exposure to companies I want to own that I didn't have access to.
True. TPG and TPG has access to that too. I think that's in their fund as well. So let's see. I like this one better though. BST has better like companies that I would rather own than
BST is
the
freaking
other one.
awesome.
Yeah, this one is definitely. I might actually talk to my father-in-law, put him in something like this. BlackRock Trust Investment Objective. Are you sure with BST doesn't have any redemptions, do they? Like forced redemptions?
I don't believe so. I'd have to reread it. I don't believe so, though.
Their total 10-year return has been about 16.8% NAV total return, and market's been 17.83. And then if you do cumulative, it's up for market price about 400%. Year to date is up 23%. So for last year is 23%. This year is not that much. Average annual. Okay. Not bad. Not bad. Okay, Steve.
All right, everyone.
Maybe we should just turn this into fixed income weekly, because I think we're both always looking for these yields, and while the market is sour on yield right now, it might be the best time to buy these yielding companies. What do you think?
I mean, I wouldn't be opposed to going down the rabbit hole next week with some of this stuff. I got a few on my list. And if Simon Property Group keeps selling off because David Simon passed away, I am probably going to add. I got to look at it.
Yeah, Simon Property is up there.
Love
businesses like this. The one good thing is that they're not AI disruption candidates.
Nope.
There's like other companies and other assets that are like AI disruption. So, they're getting hit with discounts. But if you think about it, if you have companies like this, these are companies that have great yields, that have businesses that can't be disrupted nearly as easily as other things.
You know what the best part about Simon Property is?
What?
Nobody in their right mind is putting up another mall within 20 freaking miles of them, because none of these stores are going to open up a new store down the block, because Simon Property is all Class A. Like Roosevelt Field, you know where Roosevelt Field is.
Yeah.
Nobody's putting up a new mall there, anywhere near there. The closest two are Hicksville and Huntington. And the Hicksville mall is basically done.
I mean, malls in general are kind of out of fashion now. I mean, but then again, every time I've gone to the mall, there have been people there.
Listen, Class A is a destination because you have restaurants, you got movies, you got a lot of other things besides shopping.
Yeah. No, I agree. I totally agree. Kris, do you think VG has established new long-term floor because of Qatar LNG infrastructure damage? Maybe. I can't say. I can't say. Maybe. The problem that you have to be careful with Hail the Great with VG going forward is that if the price of natural gas comes down, they're very, very exposed to spot prices. I mean, it's a big benefit to them right now, but in the short to medium term, their spot exposure is going to do really well while the market is high. But if, let's say, tomorrow morning natural gas comes down for whatever reason, we could be in for a little bit of pain in VG. The other thing is, just remember, they do have a lot of debt on the balance sheet, so that's not a bad thing. That's just part of the business model where you're during the initial phase of your build out of infrastructure, you take on a lot of debt. And the challenge that you run into is that debt markets aren't exactly cooperative right now because of resurgence in inflation. So if inflation goes up too much, then you got a problem. But other than that, it's fine. Private credit just got worse. All right. I'm loving this. I'm loving all these people dumping private credit. Just means we're getting better and better deals. Yeah. Are you buying any more Nvidia while it's low?
I mean, I bought it on Friday. I was thinking about maybe doing another purchase tomorrow. I'm not sure. Listen, I am loosely considering starting a position in Toast and Reddit. Loosely. I'm not saying I'm going to. You may see me start positions there, though. And if Nvidia sells off, then I would likely buy more.
Be careful of Toast and all the fintech names. They're just definitely not catching bids right now. Toast, and what's the other one? Reddit? There could
Reddit
be some.
is interesting because I think these LLMs are going to have to pay Reddit a good amount of money for training data.
Can you believe this thing's $26 billion?
No, I don't know why anybody uses Reddit.
Yeah. And I think they're buying back a crap ton of shares. So
the financials and the numbers are very interesting with Reddit.
Yeah. Let's check in on Sprouts Farmers Market. Sprouts
Sprouting
at 78. 78. It's in 65. It's at 78. I don't own any. That's one of those that I should have took my own advice and just bought. I should probably buy some. All right. All right, Steven.
All right.
Yeah.
I will see you on Thursday. Remember, don't leave the airport until we connect.
Yes. Yeah.
We're getting in at the same time, basically.
Exactly. Yeah, just let me know which gate you're supposed to land at.
Yeah, I'll text you all the details on Wednesday.
Okay. Thursday.
No, I'm going to text you the details on Wednesday.
Got it.
Thursday.
Got it. Okay. Makes sense. All right.
All right.
Later, dude.
Later, Kris. All right, everyone. I'll stay on for a few minutes, and then I got to hit the sheets, trying to become like Tanner. In all seriousness, I am trying to get more sleep, and, that requires me going to bed not at 1 a.m. Yes, Doogie, hit the sheets. Hit the sheets. I do need the sleep. It's no good. No good, no good. Kris is great. So, always interesting conversations him and I have. We have a very wide range of investing that we do. Doogie, what time do you get up, though? I am trying to get up at freaking 6:30 every morning now. Three hours is no bueno. I used to do 4 to 5. And when I was really young, I was doing 3 to 4. No good. I can't do it anymore. Have I mapped out the food tour in LA? I may have looked at what's near the hotel. I may have looked at it. Yeah, we're going to do some interesting things. I'm excited for LA. I'm excited to see everybody. It's going to be, listen, I want to try Dutch Bros. I want to try In-N-Out Burger. I want to try a few things when we're in LA. I am not a seafood person. The two things I'm not interested in for LA are steakhouses and Italian, because I can get all that stuff here. Hollis, maybe we make that happen. Maybe we make that happen. I'm not sure, Chels, what the plan is. Chicago's probably going to be Friday to Sunday. I don't think I really don't think I'm coming out Thursday. I got to talk to Amit. I think it's because there's really not a time difference. Probably be Friday to Sunday. We'll see. And I mean, yeah, Claude's incredible. Absolutely incredible. Oh my God. Going to bed at 10:30 every night is getting me really tired at this time. Yeah, did Amit put the stuff up for Chicago yet? Hold on. New website, meetups. Oh, he did. Chicago. Where is it? Downtown Courtyard by Marriott. Okay. Well, definitely going to be interesting. Chels, I've never been. I have no idea where Michigan Ave is. So you're going to have to be the tour guide. Yes, I will be at the LA meetup. No, I really want Chinese burgers and freaking. I mean, maybe not Chinese. I got great Chinese out here, but I wouldn't be opposed to Chinese burgers, and I want Dutch Bros. I want to see what Dutch Bros is all about. You go into Roscoe's Chicken and listen. I get down on chicken and waffles. All right. Everybody seems to like Dutch Bros, so I don't know. I'll let you know. Anyway, no, Matt, we want you there. Am I hitting the gym? I have not been, but big announcement coming later in the week. Big announcement coming later in the week. I can tell you that. Anyway, I'm going to go to sleep. Excited to see everybody. June, excited to see you out in LA. Hollis, we'll see you out in LA. And I think I will be live. Tomorrow's going to be a good episode. So I got Jared Johnson coming on tomorrow night. He is co-founder of Johnson and Randall Hedge Fund. It is going to be a very interesting conversation. I think everybody's going to enjoy it. It's going to be at 8 o'clock tomorrow night. So please tune in. I really do think you're going to enjoy it. He is phenomenal. And Wednesday will be with Tanner. And then I'll be out in LA on Thursday. So everybody in the chat, thank you very much for being here. For those of you that are in California, we will see you there. I'll see everyone tomorrow. Have a great rest of the night.